Hey everyone, just want to do a quick message here. The main thing I want to talk about is rates are going up over the next basically starting on April 15th. I'm going to cover that in a little bit. But just short term, rates are surging. By the way, they're up towards 7% again. Over the last 2 weeks, they've climbed anywhere from 3/4 to 1%. Just 2 weeks ago, right here, I was given rates 5.5 to 5.875 for the most part, maybe 6%. Now, 2 weeks later, we find ourselves way down here, which means when these securities start selling off, that means rates are going up. And today was a very bad day. And like I said, rates went up about 1/4% just in today alone. But when you look at this, like I said, the increase has been dramatic in the last 2 weeks. And we are now back to 3-month highs again, which is unfortunate, but we're hoping that they come down again. Most of that's due to inflationary concerns again and things like that. But the main thing I want to talk about was this. Starting May 1st, Fannie Mae and Freddie Mac are going to change the way that they underwrite and price transactions. That's what I want to cover. Now, some people think Fannie Mae or Freddie Mac should be on the TV show American Greed. And I'm going to show you why they think that. If you look at this, starting on April 15th, again, any loan that closes after April 15th, if you have a credit score between 700 and 779, and you put at least 5% down, you are getting penalized. Some of them pretty dramatic. If you put less than 5% down, or you have credit score under 680, you actually get a benefit, and quite a big benefit in a lot of these categories. So basically, the people that can afford it and have good credit are supplementing the people that can't or have bad credit. So the people that are, maybe they're trying to help people in underserved communities. Maybe they're thinking that people got screwed in the past, so they're trying to make up for it, regardless of what the reason is. The people that usually get benefit are people that have good credit and people that have a down payment. That's no longer the case. They are being penalized more, and that starts again in about 1.5 to 2 months. So I'm going to cover. I've done a thing before on this before, which they're called LLPA. It's loan level price adjustments, and I think it's very important now in today's environment that you have a loan officer that knows what they're doing. Otherwise, they're going to cost your borrowers thousands of dollars or create higher interest rates. If they don't know what they're doing or what to look for, basically your clients are going to get screwed. So you need to make sure that you have a competent loan officer or mortgage consultant, whatever you want to call us, and they understand how to navigate this new environment. Because it used to be able to plug in numbers and off you go. And I'm not going to say anybody could do it, but it was a lot easier. Now there's a lot more things that you have to consider, and having competency is one thing you want to make sure that that your loan officer does have. So loan level price adjustments, again, keep in mind, credit score, down payment has a loan level price adjustment. If you're buying a condo, that may have one. A new one that they just added, if you have a debt to income ratio above 40%, you're getting hit. That's brand new, and believe me, about 50% of our clients have that. Investment homes, manufactured homes. If you have a duplex, triplex, or quad, second home, those sorts of things all have loan level price adjustments. So as you go, these ones here is just for credit score and down payment only. That other stuff is in addition to all this stuff. Again, this is only for conventional financing. It does not impact FHA, VA, USDA, or jumbo loans. So just a quick synopsis. And the people that are benefiting, other people that benefit is if you're a first-time home buyer making less than $117,800, you will benefit. If you are a move-up buyer, but you make less than $94,000, you may also benefit. So let me give you a couple quick examples and bring these over. So here's example one. Credit score 725, down payment 20%, They make 135,000. Debt ratio is 42. Loan amount's 400,000. After April 15th, your client on this loan scenario is going to pay an extra $3,500 just to get this loan. And that's due to the credit and the down payment is adding an extra 0.5% in fees. And because they have a debt ratio over 40, it's adding 0.375. So overall, it's 0.875%, which equals right around $3,500. Now, if you want to take it in a higher rate, you could do that as well. That's going to result in about a 0.25% to 0.375% increase in rate. Now, let's do example 2. You got a credit score of 695, down payment of 5%. They make $110,000 a year and they're first-time home buyer. Debt ratio is 41. Same loan amount, 400,000. Normally, this client would be charged 1.875% extra, which is $7,500 in costs. Or, I mean, that'd be like at least a 1% increase in rate because they're a first-time home buyer. I'm assuming that they live in the 7-county metro area, Minneapolis, St. Paul. Again, it's going to differ on areas and counties and states. If you're listening in Florida, Arizona, other states that I do in Wisconsin, that type of thing, might be a little bit different. But this is just Minneapolis, St. Paul. Now, because they're a first-time home buyer and they make less than the $117,800, this 1.875% fees are going to disappear. They're going to have zero fees. Now, I'm not going to say zero fees altogether, but they're not going to get hit any loan level price adjustments. So the $7,500 that they would have been hit is now zero. So this client, 695, 5% down, will get basically $3,500 less in closing costs than this client at 725 with 20% down, or they'll get a lower rate by 0.25 to 0.375. So that just gives you kind of an idea of what's happening starting on, again, April 15th. So for more details, call me. Love to discuss it with you. Obviously, this is a little technical, but I think it's important to know that rates are going to be increasing in these categories between 700 and 779 for clients that put more than 5% down. My job is to find ways around different things to help improve, whether it be debt ratio, whether it be different ways, different programs. There are some other programs out there that I might be able to help with. That's my job to figure that stuff out for you guys. So like I said, obviously you entrust me with your clients, and I appreciate that. But like I said, if you have questions on this, call me. You're going to start seeing a lot of maybe news on this in the near future, but I just want to give everybody a quick heads up. Thanks.